It's my view, it's my responsibility to talk a bit about the quarter and the year. And I do have a commentary called this quarter Trump economics, and I think that is pretty obviously what was going on this quarter. So just a quick overview, the Fed's quantitative easing policies, a turnaround, the political calculation that's going on right now, a theory in progress, monetary theory, U.S.-China trade war, of course, the immediate risk with Iran, the global interest rate policies, tariff policies, and very interestingly, the Facebook announcement. So we all know, I think we're all pretty familiar that the Federal Reserve's quantitative easing program began in 2008, 2009, ended up buying $4 trillion of Treasury bonds and mortgage-backed securities. And of course, the purpose was to increase the supply of money and stimulate the economy and the financial system. As the economy recovered, however, the Fed began reversing QE. And there was a policy of slowly raising Fed rates and selling off the bond portfolio. That's all part of monetary policy. So the rearming of Fed monetary policy, so it's based on the theory of the so-called natural rate. It's a not too fast, not too slow interest rate, a kind of no intervention, hands-off, steady as the go monetary policy. And as part of the easing policy in 2018, so the Fed planned essentially nearly robotic increases in the Fed rates, and up until recently about 2 to 2.25%, toward a theoretically natural rate of 3 to 3.5%. That's a theoretical rate. Nobody really knows for sure what that number should be, but that is what most theoreticians think about. And of course, it's the purpose to rearm the federal monetary ammunition here, being ready to make future interest rate cuts to stimulate the economy again in any future economic downturn. Well, this quarter was pretty remarkable in terms of a presidential complaint here. The Fed raised interest rates 4 times in 2018, and the American economy is robust and unemployment is very low, but the president's $1.5 trillion tax cut has stopped really boosting the economy very much anymore. The trade war has hurt a number of industries. And there's definitely a slowing of global economic growth out there. So you have 2 kinds of ways of looking at the world. So the president complained that the Fed's rate increases in 2018 is what he said was it really slowed us down. And he blamed the Fed for the economic growth below 4% as he promised in his campaigns and presidential campaigns. Of course, I'm sure you know, the Democrats denounced Mr. Trump's comments because disregard for the traditional independence of the Fed and a desire to use presidential powers to help win the elections. Okay, so there's been a big turnaround. Under the pressure from the president, including the threat of replacing the chair of the newly installed president's Fed chairman, the Fed decided to reverse course and began to consider the weaknesses in the economy instead of the strengths in the economy. The central bank, at this point in time, no longer expects to increase rates. They have cut their growth projections for the economy, and they're almost certainly going to cut the Fed funds rate at the end of July. So the Fed had, by the way, this is kind of interesting though, the Fed had already cut the rate the Fed pays on bank reserves last month. The yield of 1-year treasuries had actually fallen below the bank reserve rate. So the decision was needed, and it had nothing to do with politics, to reconcile current yields with policy. So I don't think anybody has much doubt that the president is motivated to stimulate the economy to support his re-election in the presidential election cycle. Mr. Trump is banking on a much faster pace of growth than the Fed was, and many economists were as well. But global growth is moderating. There's no question about that. The slowdowns in Europe and China are underway, quite significantly in China, by the way. And there are signs of weakness in the United States. Chief executives see investment, hiring, sales growth slowing. So I call this punch bowl economics 101. and because the punch bowl is always nice to have while the party's going on, right? So, cutting the Fed funds rate in the U.S. will stimulate the economy, will reduce the cost of debt, and will encourage investment. But by the principle of conservation of energy, conservation of financial energy, I mean, cutting rates likely reduce dollar value and purchasing power, but domestic voters may not have paid much of attention to it. You know, in finance, you can't get anything for nothing. And cutting rates reduces the dollar value and purchasing power, all other things the same. And in a global economy where each country is concerned for themselves, there's little incentive to modulate policy with global implications. And by the way, the president called out Dr. Draghi at the European Central Bank for doing exactly what we're planning on doing here now. By his interest rate cuts, reduce the value of the euro vis-a-vis the dollar, just what will happen here. So the other way to think about all of this, though, is that modern macroeconomic monetary policy is a theory in process. Okay, the global economy is in a state of economic theory uncertainty, and that I think is worthwhile for people to understand. At the moment, there is roughly $13 trillion of debt and negative interest rates in the global economy. Think about that: $13 trillion of debt and negative interest rates in the global economy. You have to pay people to take your money, okay? Part of the policies to stimulate global economic growth, a state not anticipated by either Keynes or Samuelson as they were developing macroeconomic theory. So it's not at all unreasonable to say that many theoretical principles may not be working that well. So let me turn around now to think not only in terms of what has happened and what is happening, but what the risks are going forward. There's no doubt at all that the single most important risk in global capital markets is the U.S.-China trade war. A truce has been called by the President and President Xi. Is it temporary? Is it permanent? Will the tariffs that are currently in place remain permanently in place? Will there be new tariffs? The issues between Presidents Trump and Xi are not really truly reconcilable. A reversal of China's 2025 economic agenda would almost certainly lead to the fall of President Xi's regime and would be a very bloody mess in politics in China. So while the conflict festers, however, and it is not resolved, there is a stalemate of possible armed conflict in the China Sea and lots of cyber attacks. So this is not a good thing. The most immediate risk, however, is, in my view, Iran. Now, there is a legitimate case here. The president's effort to contain Iran's interest in nuclear weapons, while Iran supports conflicts in the Middle East and beyond. So there is an issue here, and the president is definitely right to be concerned about it. But the American government is imposing draconian sanctions on Iran in order to force compliance to American demands. And by the way, we're just all by ourselves in all of this. Virtually all of the major countries in the world, European, China, and Japan, and even Russia, I believe, signed this policy with Iran. Another issue is this. It should be remembered that Iran represents a very proud Persian culture that runs through the world. Iran may prefer conflict than any subjugation by the American government. The president's cancellation of the Iran treaty was very likely to be a serious error that could easily lead to a new war in the Middle East, and we keep hearing things going on all of the time about it. Okay. The negative rate policies. Dr. Draghi is a brilliant econometrician, but his willingness to use more negative interest rate policies to stimulate the Eurozone is extremely risky. It's way beyond modern monetary theory, at least in terms of well practiced by theoreticians. Its success and the consequences are certainly uncertain. And of course, there's plenty of other problems. The problems of European fragmentation remain. Italy is fiscally unstable. Brexit challenges the unity of the European bloc. No central banking system. No political will for a coherent fiscal stimulus. So a thriving Eurozone economy is unlikely any time in the future. And then, of course, much closer to home, we have what I call election angst. The upcoming presidential election in the U.S. it will be in full swing starting just very soon in September, and all the way till next November. And so there'll be lots and lots of political and monetary policy uncertainty, likely raising all kinds of volatility, both domestically and in the global markets, because we certainly have seen it in global markets as well. And the continuing saga of the Mueller report is not finished. The impetus to impeach the president by a number of people in Congress, the continuous strip of revelations, the continuing conservative meddling, and all of this is not at all unlikely to lead to a constitutional crisis by election time. Tariff policies. The president has often complained of unfair trade policies, even with America's trading partners, and he has a good, legitimate reason for doing so, because such issues have legitimized by jobs leaving America due to industry protectionism policies by many of even the United States' many, many longtime allies. But a disruptive trade policy can be raised to a new level, and it was. The president threatened to raise tariffs with Mexico if they did not stop the flow of immigrants from South America. Weaponization of trade policy is widely perceived as a grave threat to all of America's global trade agreements. What about the healthy American economy? Well, the president claims that we have the greatest economy ever, but he's also demanding the Fed cuts rates to stimulate the economy. So the Fed has been in a wait-and-see policy, but I think very likely to change very soon here, given the president's re-election concerns, although there has been some pushback by the Federal Reserve Chairman recently. But sentiment in the business community could be seen shifting as well. There is the context of weak growth abroad, slowing manufacturing, the trade war with China, other geopolitical risks. I looked at a report from the Washington Post that was very recently published here on the health of the American economy, and I think that was a very nicely balanced report that said that it was very healthy but not invulnerable. Okay. So one final thing to say and talk about this particular quarter and this particular year to date. I was really surprised, and I think a lot of people were at least, that Facebook plans to create a virtual currency called Libra, which has a number of similarities, superficial, no, not really superficial, so a number of similarities to Bitcoin and other cryptocurrencies. But unlike the others, it's backed by real financial assets. It reflects a basket of securities that will include the dollar. Its payments process will be backed with Visa and MasterCard, so very, very different from Bitcoin exchanges, and will be centrally domiciled not everywhere in the internet, but in Switzerland. So it's different. It's very different as well. Libra may change the narrative about cryptocurrencies because that narrative up until now has been really all over the place here. The potential threat to existing bank policies may be very significant, even severe. The regulators will definitely have lots of questions concerning this proposal. It may even impact central bank ability to manage their economy. But I think it's extremely foolish to dismiss Facebook's technological genius for using the internet in novel ways. But there are many institutions that are going to be aligned to try to rein in Facebook's ambition. It's really quite a remarkable thing here. And just to put a little bit in context, gold recently surged with a 9.9% return this quarter. And that is a very large return for gold. But gold rises when global risks increases. While everything else goes down, gold goes up in some sense, okay? Well, Bitcoin has also surged from $3,000 to a recent high of as much as $14,000. The surges in both Bitcoin and gold reflect these trade war risks and the global economic uncertainty. So gold is a classic example of a universal currency or numeraire asset, and Bitcoin and others are also similar with about much, much higher volatility than gold. Libra may be the new gold. or a more institutionally useful Bitcoin? I'm sure that we will all need to do a lot more research on this very interesting proposal.